Let's move on to the bond market, where we have on the line Samir Gadio. He's going to be talking about the West African bond market with us. Samir, are you there?
Yes, good morning.
It's good to have you on the show. Now, let's start with Nigeria. We saw bond yields pick up marginally, now around 12.6, 12.7%. Now, given the excess liquidity in the system, what's the outlook for the bond market?
Well, I think the irony in a sense is that even though the central bank left the policy rate unchanged at 12% at this week's MPC, in recent weeks, they've actually allowed an accumulation of excess liquidity in the system, which drove yields down. Now, we got to a point where I think we found a floor at the long end of the curve, because it's a bit difficult for bond yields to decline further and, let's say, break the 12% threshold. Investors are increasingly cautious about the medium-term outlook domestically. That is the transition at the CBN in June 2014, the likely deterioration in fiscal policy as we move to the next elections. And so I don't think there's any significant appetite for duration. And investors are also worried about the fact that if yields go down too aggressively, then at some point there's going to be a sudden reversal and they'll be caught off guard. So I think we've probably reached a level where the market will stabilize for some time. That is 12.5, 12.6, 12.7%, but we're not going to go further down, and it could be that actually at some point those yields pick up a little bit, despite the fact that we have a lot of liquidity in the system, and even though inflation is at 7.8% as of October, there's actually a momentum for the short end, so we're seeing some investors switching to the short end from the long end.
Samir, let's move to Ghana. I mean, we continue to see increased pressure on the cedi, and we've seen the Bank of Ghana increase market rates as a result. So run through some of the key issues in that space.
Well, so the big event there was the 2014 budget, which was presented this week. As we expected, the fiscal consolidation that's going to happen will be very gradual. So the target for next year is a deficit of 8.5% of GDP from about 10.2% this year. Now, it's true that there is an improvement, but at the same time, this is still a big shortfall. When it comes to the market environment, we've seen actually yields decline in recent weeks, and I think the government has realized that the current financing costs are just not sustainable, because if you continue to borrow at 20+%, at some point your service. Your debt service is just going to become completely unsustainable.
Samir, let's quickly touch on Cote d'Ivoire. Now, we hear the government has started a book building for a new 5-year TPCI bond to the tune of $186 million. So tell us very quickly about that.
We expect the bond to be oversubscribed. There's limited supply of fixed income instruments in this region, a lack of investable assets. So the banks and to some extent even the local pension funds will definitively buy. 6.3% versus inflation at 1.7%. Those are attractive real rates, so we think that this deal is going to fly.
Samir, let's leave it there. That's Samir Gadio, emerging market strategist at Standard Bank.